The most powerful economic shifts rarely arrive with sirens. They do not interrupt television broadcasts or announce themselves with dramatic speeches. They arrive quietly, buried in legislation, written in technical language, passed late at night, and ignored by people who assume nothing important could possibly be hidden there. History shows that when governments expand authority over assets, it almost never starts with force. It starts with permission. That is what makes the current moment so unsettling. Not because anything has been seized, not because doors are being kicked in, but because the legal framework that would allow seizure has been widened, clarified, and normalized under a new justification: climate security, supply chain resilience, strategic necessity. The language feels modern, the mechanism is not. When lawmakers talk about strategic materials today, they are not talking about abstract concepts. They mean physical things, metals, inputs, resources that modern economies cannot function without. Silver, platinum group metals, rare earths, industrial inputs that sit quietly inside solar panels, electric vehicles, power grids, and defense systems. Without them, the green transition stalls. Without them, national targets become impossible to meet. And when a government decides something is essential, markets stop being the final authority. This is the shift most people miss. Governments do not seize assets because they hate markets. They intervene when markets fail to deliver what the state needs on its timeline. That is not ideology, it is logistics. When supply chains tighten and demand becomes political, ownership becomes conditional. Recent legislation has expanded the state's ability to identify, inventory, and in extreme circumstances, acquire strategic resources during declared emergencies. This does not mean confiscation is happening today. It means the rules governing what is possible have changed. The authority now exists in clearer form than before, and history teaches that markets react to authority long before it is used. The language is careful. Terms like temporary control, just compensation, and national interest appear repeatedly. These phrases are designed to sound reassuring, and legally they are. They acknowledge constitutional limits. They imply process, they signal restraint, but they also establish something crucial, that private ownership can be overridden under certain conditions. Not arbitrarily, not secretly, but legally. This is not new in principle, it is new in application. For most of modern history, emergency economic powers were associated with war. Factories were repurposed, materials were requisitioned, production was redirected. Citizens accepted it because survival demanded it. Today the justification has evolved. Climate transition is framed as a long-term emergency. Supply chain vulnerability is framed as a national security risk. Energy independence is framed as strategic necessity. Different language, same structure. To understand why this matters, you have to understand how power actually expands. Governments rarely invent new powers out of thin air. They reinterpret existing ones under new conditions. Climate policy provides the perfect vehicle because it is moral, global, and time-sensitive. Few politicians want to be seen opposing it. That creates consensus, and consensus lowers resistance. Once something is labeled essential, the debate changes. It is no longer about price discovery or market efficiency. It becomes about access and control. Can the state guarantee supply? Can it prioritize allocation? Can it intervene if private ownership conflicts with public goals? These questions are no longer theoretical. They are being discussed openly in policy circles. History provides a clear blueprint for how this unfolds. In 1933, during the Great Depression, the United States government issued Executive Order 6102, requiring citizens to turn in gold. This is often remembered emotionally and inaccurately. What actually happened was slower, legalistic, and justified as economic stabilization. Compensation was provided at the official price. Courts upheld the action. The policy was not permanent, but it was real, and it set a precedent that still echoes today. The lesson from 1933 is not that confiscation is inevitable. The lesson is that emergency powers expand fastest when fear feels justified. At the time, fear was financial collapse. Today, it is climate instability and supply disruption. Different crisis, same mechanism. What makes the current situation distinct is that the groundwork is being laid before a visible emergency. Authorities are not seizing, they are mapping, not confiscating, inventorying, not acting, authorizing. This matters because markets are forward-looking. They do not wait for action. They price risk when the rules change. This is why precious metals and strategic materials react faster than equities. Stocks depend on earnings. Commodities depend on access. When ownership rules feel flexible, volatility increases. Premiums rise, hoarding behavior appears, liquidity tightens. None of this requires seizure, it only requires uncertainty. And uncertainty is the most powerful force in any market. The silence surrounding these changes is not accidental. Complex legislation rarely trends. Technical authority does not go viral, but silence has consequences. When people eventually discover that the rules shifted without their attention, trust erodes, and when trust erodes, markets move violently. This is not a claim that mass confiscation is imminent, that framing is emotional and inaccurate. This is a recognition that ownership is becoming conditional in new ways. The definition of yours is evolving under the pressure of collective goals, and once that shift begins, it rarely reverses cleanly. Governments still face constraints. Courts matter. Compensation matters, political backlash matters, international capital matters. These limits are real. They slow action. They complicate enforcement. They prevent extremes, but they do not eliminate the underlying authority. They only shape how it would be used. The key insight of Chapter 1 is simple and unsettling. Power has moved ahead of necessity. The authority exists before the trigger arrives. And history shows that when triggers do appear, markets do not wait for confirmation. They reposition first. This is why investors, institutions, and even governments themselves are uneasy. Not because something has been taken, but because something has been allowed. The shift is legal, procedural, and quiet. And those are the shifts that matter most. The story is not about panic. It is about preparation. Not about fear, about understanding. Ownership today is not being challenged openly. It is being redefined slowly under the language of resilience and necessity. And the most important part of this story has not happened yet. Because laws do not act on their own. They wait. Laws do not act on their own. They wait. They sit dormant until a moment arrives that makes their use appear reasonable, even necessary. This is the part of the story most people misunderstand. Confiscation does not begin with force. It begins with justification. And justification almost always arrives wearing the language of urgency. In every historical case where governments expanded control over private assets, the sequence followed the same pattern. First, authority is established. Then, visibility increases. Then, an emergency is defined. Only after those steps does action become politically survivable. What matters most is not intent, but timing. Power that exists without a trigger feels theoretical. Power paired with crisis feels inevitable. The missing ingredient is always the emergency. Legally, emergencies are flexible constructs. They do not require catastrophe in the cinematic sense. They require designation. Wars qualify, financial collapses qualify, energy shortages qualify, supply chain disruptions qualify. The threshold is not public panic. It is institutional agreement that the situation threatens national objectives. Once that agreement is formalized, the conversation changes instantly. The question stops being whether intervention should occur and becomes how quickly it can be implemented. History makes this clear. During wartime, governments did not ask factories whether they were willing to convert production. They ordered it. During energy crises, rationing did not begin because shelves were empty. It began because planners feared they might be. The logic is preventative. Act early to avoid worse outcomes later. This logic is difficult to oppose in real time because the cost of inaction is framed as unacceptable. This is why modern policy focuses so heavily on inventory and reporting. Before any seizure is possible, the state must know what exists, where it is, and who controls it. Visibility always precedes enforcement. Reporting requirements feel administrative. They are presented as neutral data collection, but they serve a deeper function. They map the terrain. Once assets are visible, behavior changes. Owners adjust voluntarily. Some sell, some relocate. Some comply more closely than required. Governments understand this dynamic well. Most compliance occurs without compulsion. The mere presence of authority reshapes incentives long before force is considered. Markets respond even faster. Prices move not because something has happened, but because something could happen. This is why commodities tied to strategic policy objectives experience volatility ahead of legislation being used. It is not fear. It is probability management. Traders price scenarios. Investors hedge uncertainty. Liquidity tightens because participants demand higher compensation for regulatory risk. This is the phase we are in now, not action, anticipation. It is also where most misunderstandings arise. The absence of immediate enforcement is mistaken for the absence of consequence. In reality, markets often do the work of policy before policy is activated. Hoarding behavior increases. Physical premiums expand. Long-term contracts adjust. Insurance costs rise. None of this requires a single confiscation order. It requires only ambiguity. Ambiguity is powerful because it cannot be litigated. You cannot sue a possibility. You can only respond to it. At the same time, it is critical to understand the limits that still exist. Emergency authority is not absolute. Constitutional protections matter. Courts matter. Compensation clauses matter. Political backlash matters. Administrative complexity matters. Large-scale confiscation is expensive, slow, and politically dangerous. It is far easier to regulate flows than to seize stock. It is far easier to influence markets than to confront owners directly. This is why historical examples of outright confiscation are rarer than people assume. States prefer softer tools, price controls, mandatory sales, export restrictions, priority allocation, taxation, regulation disguised as compliance. These mechanisms achieve similar outcomes without the optics of seizure. Ownership remains technically intact, while control shifts quietly. This distinction is essential. The story is not about losing property overnight. It is about the gradual transformation of ownership from absolute to conditional, from something you control freely to something you hold as long as it aligns with public objectives. This transition does not announce itself. It normalizes itself. Climate policy accelerates this shift because it reframes material access as a moral imperative. When objectives are framed as existential, resistance is portrayed as irresponsible. Debate narrows. Trade-offs disappear. The timeline compresses. This does not require malice. It requires consensus. And consensus is easier to build around long-term threats than immediate costs. Markets understand this intuitively. They do not wait to see how far authority will be used. They react to the fact that it exists. This is why volatility often spikes before any enforcement action. It is also why silence from mainstream coverage increases speculation rather than reducing it. When information feels incomplete, participants fill the gap with worst-case planning. Yet even here, restraint remains real. Governments must weigh the cost of intervention against the risk of capital flight. They must consider international repercussions. They must manage domestic trust. Overreach creates backlash that undermines legitimacy. The state is powerful, but not omnipotent. This tension acts as a brake. What emerges from this tension is not a dramatic seizure, but a rebalancing of power. The state gains leverage. Owners accept new conditions. Markets price higher risk premiums. Over time, behavior adjusts. This is how modern economic control expands, not through confrontation, but through normalization. The most important realization of Chapter 2 is this: the presence of authority changes outcomes even when it is never used. Once the rules allow intervention, the system reorganizes itself to accommodate that possibility. People act differently, markets behave differently. Ownership feels different. This is why the debate is often framed incorrectly. The question is not whether confiscation will happen tomorrow. The question is how the possibility of it reshapes decisions today. And that reshaping is already visible. Investors diversify jurisdictionally. Institutions favor assets with clearer legal frameworks. physical markets demand higher premiums. Long-term planning incorporates regulatory risk as a permanent variable. None of this requires panic. It requires awareness. The historical pattern is consistent. Emergency powers expand in response to real pressure. They persist longer than expected, and they rarely fully retract. Each crisis leaves behind a slightly altered definition of ownership, authority, and obligation. The shift is incremental, not revolutionary. That is why the most accurate way to understand the so-called green confiscation is not as an event, but as a process. A process where environmental goals, supply chain fragility, and national security concerns converge to justify expanded control over physical resources. The outcome is not mass seizure, it is conditional ownership. And conditional ownership changes everything. The final point is the calmest and the most important. Awareness restores agency. Understanding the rules allows individuals and institutions to adapt rationally rather than react emotionally. History does not punish preparation, it punishes denial. Every generation relearns the same lesson in a new context. Ownership is strongest when it is invisible, and power expands most efficiently when nobody is looking. The authority now exists. The trigger has not arrived, and the space between those two moments is where the real story unfolds.